right, this is another episode of Tower Talk, Navigating Markets. This is Mark and Tarek. This month's episode is one that's really interesting. It is about timing the market. Can you time the market? Can you perfectly pick the high and sell? Can you perfectly pick the bottom and buy? One of the longest or the toughest questions in investing. And you know what? It's unfortunate, but the answer is really easy. No, you cannot. It is not possible to time the market, but that is not the end of the episode. It's actually a lot more complicated than that, and it's a lot more interesting than that.
We're done.
Yeah, exactly. Um, so it's not possible to perfectly pick. This is the day that the market is at its peak. Let me sell, and it's not possible to do the opposite, but it is possible to generally read some trends in the market. So, for example, one that's I'm certain in most people's recent memory is the COVID crash, right? In 2020, March, the market dropped 35% in a single month. And generally speaking, we can say, well, there's a correction like that, a solid recessionary correction. That's generally a good time to buy. When the market is down, it's a good time to buy. We don't know if you're going to buy and then it's going to continue to go down. You don't know if you're going to buy and it's already on its way back up. But we do know that when the market corrects, that is generally a good time to buy. And so we've done there's a lot of firms that have done some interesting research on this. I'm going to move on to some research. It's done by Charles Schwab. It's really, really interesting. What they did was they took 20-year periods, every single 20-year period back from 1926 forward. Okay. Now the one they published, or the one they made the most detail on, was 2001 to 2020, and they took 5 different investors or scenarios. Each person had $2,000. The first person invested their $2,000 on the best day of the year, the lowest market day of the year. This was Peter Perfect.
And that's 2,000 per year.
Per year, so 40 grand altogether.
Right.
Yep. And they invested on the best day of the year, starting in 2001 all the way to 2020. Then there was the second person. They invested $2,000 just on the first day of the year, regardless of what the market was doing. Third person took their $2,000, divided it by 12, and invested it monthly. No plan as to what time of the month. Just every month they invested 2,000 divided by 12. And then they actually had a simulated person invest 2,000 on the worst day of the year, the lowest market day of the year. And then finally, they compared this to someone who just invested their $2,000 a year into treasury bills or just a savings account. Now, the results are quite interesting. So firstly, the person who invested on the lowest day of the year, the perfect timing person, no surprise, they made the most money after 20 years at $151,000. Okay. Now, what is very, very interesting is the person who invested $2,000 at the beginning of the year, they made $135,000 over that time period. And so the difference is just 15 grand over 20 years. So, $700 a year, less than $1,000 a year. The person who invested 2 grand divided by 12 every month, they made 134 grand. Negligible difference. That's not really even worth making a decision on. And then, we compare this to, had you just put your money in a savings account, you would have only made $44,000. Remember, you started with 40, so you made 4 grand in 20 years.
And then the one who did the worst.
The person who invested on the lowest day of the year, you'd think they would have done terribly, especially compared to the cash position. They ended up with 121,000 after 15 years.
Buying on the high each year for 20 years.
Yep. They bought on the day the market was the top every year for 20 years, and they ended up at 121,000. Now, what's interesting here is we already know you're not going to be able to pull out your crystal ball, pick the best day. So you can't be the person with the perfect timing. It's not possible. We can do this retroactively. What this is saying is just invest regularly. This person who put 2 grand in a year, the person who put 2 grand in, 2 grand divided by 12 in every month had basically the same returns, and they were strong returns over that time period. The person who stayed in cash did not make that much money over the time period. It's instructive. It goes back, and I'll post this article because it's got a lot more detail. They actually do it every 20-year period starting in 1926. It's extremely interesting. And it just shows, can't time the market, just get invested.
That's cool. That's great information.
Hmm.
I thought I would follow what Tarek said there with some of the great corrections. So the great corrections are the things that you want to avoid. I mean, you want to be part of, right? You want to figure out when is this peaking
Hmm.
out and when is it going to drop and how much does it drop? So most of us would remember the dot-com bubble of 2000 or 99, 2000. The market at that time peaked in June 2000 at 11,250. This is the TSX. And it took 18 months until from June 2000 until December 2002. And it dropped 42% to 6,555. Okay, so a 42% drop over 18 months. Next, it took 5 years to recover to the high it had been of 11,250 in June. So the high down to the low, then back up. How long did it take? 5 years. Okay, and there's a 42% drop.
Mm.
But it didn't peak at 11,250 in June of '05. It just went on through until '08. And we're going to talk about that in a second. So in '08, we had another crash. And most of us remember it as a very painful October. In fact, it started in March of '08 at 14,700. It dropped 45% over 9 months. So not 18, but 9 months.
Hmm.
About the same amount, 42%, 45. This one is at 45. And it took 6 years to recover from the high of March '08. And then it climbed on through. And at 14,700, well, it climbed through, and it's now at 20,200, I think, TSX.
Yeah.
Let's
I'll
see
quickly look that up
here.
here.
We all remember the one that Tarek just talked about at the beginning of COVID, February 2020. The TSX was 17,850. And 1 month later, on March 16, it was 11,850, a drop of 34%. And that's when cash injection, responses across the market, people began to realize there are some companies that are going to thrive in this environment and others that are not. And so it bottomed about March 20th and took off. I remember seeing about April 10, it had bounced 20% off of the bottom already.
Right.
And it continued to climb, and 1 year later it had recovered to the previous high of 17,850, and it has since gone through to, what is it now?
It is
20,000?
20,180. So maybe, yeah.
Call it 20,200.
Yeah.
The point that I want to make in that is people figure out rules or they find patterns in previous events and they try and apply them to the current or future events. That's a really risky assumption. There are
Hmm.
there are different events happening, there are different things that are going on, which is why I think Tarek's, work of finding that 20-year research, that's actually really interesting. Putting money in regularly. Some people call it dollar cost averaging. I'm not sure that's the best term for it. It's just regular discipline saving and finding good investment managers. Um, so, among the rules of good investing among institutional investors is to avoid torpedoes. I've mentioned this before. I
Hmm.
mention it again. It is really important to avoid torpedoes, and therefore, um, putting money into a friend's business that's a real flyer. It could be a 10 bagger and it might go to zero. That's called a torpedo risk.
Hmm.
If you have a chance of it and knowing that it's going to go up and there's something that you know that others don't, okay, fine. But many of those turn into torpedoes. They hurt your investment, and then suddenly you're scrambling to try and make up the money that you put in. Avoiding torpedoes can be done two ways. One, buy companies that have good fundamentals. Buy companies that are here producing dividends, producing
Hmm.
cash flow, and are continuing to grow. That's kind of what we try and do with fundamental indexing. And the result is the fundamental index on average over time outperforms the reported index, which includes all stocks, and therefore it has some torpedoes built into it, right? For example, two torpedoes that I can think of within my career time, Briex and Nortel. Neither one ever produced a profit. Neither one ever produced a dividend. Neither one had book value. And yet Nortel was 12% of the TSX. Yeesh. That thing was waiting for a crash. And I remember when it was half of its previous price, I went to my partner and I said, it's 50% down. Should we be buying it? And he, smarter than I, smarter than me, I'm not sure which is the right pronoun there. He said, Mark, it's still trading at 60 times revenue. The next 60 years of revenue is represented in its price.
That makes sense. Yeah.
He was right. And that was a good call. That's a torpedo.
Yeah.
Note, markets do correct. That is a fact.
Nothing you can do about that. That will always happen. Yep.
And using the market corrections to buy, my guess is the right rule for if you want to try timing is buy when the market is down 20%. That's actually a pretty big correction. It happens fairly regularly. And that usually is most of the correction throughout history. There are the big ones, 42, 45, and 34%. But if you think that every correction is going to be 45%, you're never going to get back into the market.
Right.
We used to talk also about, the idea of trying to time the market, and we called it trying to catch a falling knife.
Yep.
The market is, you manage to get out somewhere near the top, and now when do you buy back? And you're always thinking, do I swing in there and grab that handle, or am I going to get cut with the knife? The answer is just put your money in, think of it as 5 years. Remember, the crash of 87, which really was upsetting to many parts of the world, that was when the Soviet Union defaulted on its debt. TSX was 3,200 and it fell to 2,200, and it took 2 years to recover to the 3,200. 30 years later, we don't even care what the level was. It's long since recovered. We've long since climbed back out of that ditch.
Absolutely.
What do you have to add, Tarek? I've got a couple other things, but I don't want to do all the talking.
Absolutely. And it's just going to emphasize what you said. Markets are going to correct. It's a natural part of the capital cycle, right? Bad companies, people get exuberant. Correction's a normal thing. Now, what does that mean? Do you have to watch your portfolio drop 45% every time the market corrects? Obviously we are unable to guarantee anything, but what Mark emphasizes, you have trusted portfolio managers who are managing your money to ensure that when markets do correct, because they will correct, you will not feel the full burden of that correction, right? Through our fundamental indexing, we're going to, through the math built into the strategy, we're going to avoid torpedoes, companies that don't have any sort of substance behind them. The momentum strategy, it is rebalanced every quarter. For those of you who are familiar with the strategy, and so companies who stop performing, they're kicked out. There's no, well, Mark and I think we should hang on to that one. That one's going to come back. What the algorithm says, we do. It's kicked out when it stops performing. A quarterly rebalance we have found is sufficient time to notice when a company stops performing and get it out. And that's the sort of thing that we recommend to handle market corrections. And, Mark, I think, we can end on, you wanted to mention why do stock markets continue to go up? I think that's a great place to go.
Sure, let's go there. Why do markets continuously go up? It's like, it's counterintuitive. This is is it a growth machine? Will it go up forever? Well, my question to you, if you're asking that one, is what do you think about human ingenuity? The executives, the people who are running these companies, the people that are responsible for them, what are they doing? They're looking at underperforming units and they're eliminating underperforming units. If their whole company is losing money, they're going to actually shut the whole company down. And that will take it right out of the indexes. It'll take it off the market. and then they'll find some other takeover way to bring it back. Great example of that, Eastman Kodak. What a great company. It was actually one of the Dow component, a Dow 30 stock for decades. And how in the world is it not here? Well, they missed that. They were making buggy whips when automobiles came in. They were making film cameras and processing film when the world moved to digital cameras, and they missed the trend.
They really did.
And so they're out of the Dow. They're had to go into bankruptcy, had to restructure, but human ingenuity is now rebuilding that company. Even that company is coming back. So
Yes.
it's the God-given nature of humans to build stuff. And that's why markets, there are these corrections along the way. And these are actually the wake-up calls for people to get busy, make some corrections, get these out of it, so that their company can continue to grow. And they do. These companies are spectacular, strong companies. I had one more thought. I was
What's that?
remembering back when I was in the institutional research market. One of the things that was watched by institutional investors very closely on when was the top of the market, what was the bottom of the market, and part of their selling or buying decision. They watched retail buyers and retail sellers of stock. In other words, typically there is a run of retail investors when the market is very close to the top. At that point, institutional buyers start raising cash. That's what they call it, selling. They start raising cash. And they're going, okay, there's too much retail interest in this. It's not that there's too much retail interest. It's just typically retail interest is so lagging and so late that by the time you're getting to the top of the market, they're showing up because they're all excited. They're all talking with each other at their parties, or they're talking with their people on the elevator. They're going up in the elevator talking about stock. When that happens, the market is very close to a top. And we used to joke about that. The other thing that they watch for when to buy is when there's very little retail buying. Retail buying has dried up. In fact, at that point, retail selling becomes very, very heavy. And when the market's down and retail selling is heavier, we used to call that the puke zone, because retail investors can't handle that pressure. They start throwing out their stocks. I can't take this anymore. I'm out. And that's when institutional investors start going, I got this 10% cash over here. I think I'll put it into the market today. And so retail investors are actually one of the secrets that institutional investors have. They just watch the market with what we're doing as individuals. And by and large, they're proving that they're right and smart. And we're not all that good at it. So we just figure out systems around it.
There you go.
Thank you.
Don't be a retail investor that the institutional money is relying on. Don't signal.
There you go.
Look at the signal they're looking at. Yeah.
Anyway, thanks for your time.
Catch you guys later.
Bye.